Amazon is up 87% over the last 12 months, and analysts still believe there is a ton more upside to come with this company that continues to increase their free cash flow significantly. We're going to look in today's episode, is it still an undervalued buy? We're going to take a deep dive into their total revenues, their growth on the top line, as well as their bottom line net income. We're going to take a quick look at the health of their company, total cash versus total debt. We also want to see how they've performed versus some competitors and those in the industry. We'll also look to the institutions. Are they still buying or selling Amazon shares over the last few quarters? And we'll discuss the mass sell-off that we have seen from insiders, including Jeff Bezos. Don't forget, we'll look at the financial metrics. We want to understand, is there a lot of growth and what sort of percentages are we working with? And we also want to just run through the fourth quarter results, pointing out a few things that really caught our eye. And finally, as always, we'll put them through the valuation model, getting to our intrinsic value and our acceptable buy price using that investor margin of safety, as well as looking at Wall Street, their price forecast. And more importantly, we want to run through a few different scenarios on the DCF model, looking at some low growth rate forward looking, medium as well as high. So let's jump straight in. So we have the essential historical data. Over the last 10 years, they are up 837%. We can see as well they aren't too far from their all-time highs of around $184, $185. And they currently have a forward PE of 41.55. Now, in terms of the top line numbers, for regular companies, steady moderate growth, 3 to 7%. For fast-growing companies like Amazon, we do expect much faster growth. 280 billion reported on the top line in 2019. We can see here more than double that 5 years later in December 2023. Their full year results looking absolutely incredible. And on a more granular level, what we see is that top line has been increasing every single year for the last 5 years. Absolutely insane. We're going to look at the last 10 years percentage wise as well shortly. When we compare it to the bottom line, 11.6 billion net income in 2019, 2023, 30.4 billion. So we see nearly 3 times growth to the bottom line over the 5 years. Top line doubled over the last 5 years. Bottom line nearly tripled. Although we do note a little bit of an inconsistency on the bottom line. We see an increase all the way to 2021 before a drop to, in fact, a net loss and then picking back up to a very strong net income. So a little bit of an inconsistency. Nonetheless, over the last 5 years, a very strong performance on the income statement. Quick health check then. Total cash versus total debt. 55 billion of cash and short-term investments in 2019. 87 billion in their latest report. So again, we see that their cash has increased over the last 5 years, looking pretty strong, 87 billion. And when we compare that numerically as well as directionally to their total debt, we see in fact it has more than doubled from 77.5 billion to 162 billion. So a little bit of cause for concern there. It has doubled, which is already a huge amount in 2019, but we will take a look at the net debt to EBITDA metrics to understand if there is anything to be worried about on that front. Now, comparing their performance to some others in the consumer discretionary, although we do note some of them aren't direct competitors, we have Alibaba, PDD Holdings, Mercado Libre, as well as a few well-known others. Now, over the last year, in fact, last 12 months, Amazon is the best performing, up 87%. So performed very well. We do know 3 of the 5 here that we are looking at, or of the 6, have returned negative. So very strong performance. When we extend this to the last 5 years, we in actual fact see Amazon up 107% in the middle performance of those competitors. So whilst it is interesting to note, and maybe 107% isn't the greatest return on an investment over the last 5 years, depending on your goals as an investor, nonetheless, still fairly strong. But remember that the past performance of any of these stocks that we're looking at, not just Amazon, is no indicator of future performance. Now, institutional ownership, it does sit at 58%. We can see 48 billion worth of sales by these institutions over the last 12 months, nearly double the buys over the same period. So we can conclude that institutions over the last year have been buying more shares of Amazon than selling. And we also note in Q4, the more recent quarter, institutions are still buying a lot more. So very bullish on Amazon, as we can see, as well as the last 3 quarters with more buying than selling. Now, insider trading, we do want to take a look at both buys and sells within the last month. Now, we can note here from this long list, only sales that have been performed, and we can see Jeff Bezos has sold a significant amount of shares. We see 2 billion worth on the 8th of February. Again, we see around a similar amount on the 12th. And he has sold or has continued to sell a lot of his shares, although he still does hold a fair amount. Now, overall, while we do see a lot of these shares being sold, it is important to remember that it isn't necessarily a bearish signal, as there are many reasons why insiders sell. And if you do want to gain some kind of happiness, you can see that since they have sold the majority of these, they have essentially the share price increase from that point. So no one can really time the perfect time to sell their shares. But again, it isn't something that we would consider to be a bearish signal. Now, before we jump into the financial metrics, just some incredible results for Amazon over the last year, which is very important to understand when we look at that essential valuation. The net sales of the Q4 increased 14% to 170 billion. This was compared with 149 of the same quarter in 2022. Operating income increased to 13.2 billion versus 2.7 from the same quarter last year. So a massive increase. Bottom line increasing from 10.6 billion to 0.3 billion. So overall, Q4 was absolutely incredible. We did see the share price pop after these results were released. Absolutely insane. Now, we won't run through the full year results. We did do an analysis not too long ago. The only thing I did want to bring out from this, which is very imperative when we look at the valuation model, the free cash flow improved from an inflow, so that's positive free cash flow, 36.8 billion for the trailing 12 months versus the previous year when in fact it was negative. It was an outflow of 11.6 billion. Now, absolutely incredible, and on top of that, they are now expected to increase their free cash flow very rapidly, which is why we did see the share price increase a lot. So let's take a look at that information. Free cash flow per share, personally, what I look at, you always have this data available, the EPS, but personally for me, susceptible to manipulation by management through accounting. Free cash flow per share, now we do see it increase from 2014 to 2020. It did drop negative in the 2 years, 21-22, which is why we did see that big pop in 2023. And in fact, the share price dropped quite significantly during those last 2 years. Now, what is key to understand, 2024, they are expecting this to nearly double from 2023's 313. Bear that in mind, they're expecting nearly a 100% increase. That is going to be important when we look at the three different, essentially high, low, and medium targets for the future years. Sales growth, double-digit growth nearly every single year, bar 2022, 12% in 2023, very strong. Now, you could argue maybe we'll see the growth slow down, but so far it's not looking like that with double-digit growth, very, very strong. Total sales then 89 billion to 575. They are continuing to increase that top line year after year after year. And one thing to note, shares outstanding, however, they would have diluted your position if you were a shareholder in 2014, issuing shares 9.24 billion to 10.5. But as I do typically say, when a company has performed as strongly as Amazon over the last 10 years, this probably wouldn't be a massive worry. Now, in terms of the ROIC figure, this is very important. It is one of my 7 golden dividend metrics. And if you want to see the other 6 in detail, I have released my latest free weekly article. Amongst all the other articles, I do talk about the 7 golden dividend metrics, as well as a lot of wealth of information, all easily accessible, completely free. Just click on that pinned comment below to sign up, and you get access straight away. Double digits is what I'm after to give me faith that management are able to effectively allocate their capital. 10% in 2023. We do see it pretty inconsistent, but I'm hoping from this point onwards, given their very strong results from 2022 to 2023, this will start to pick up. Operating margin, now this is one that I would like to see them improve slightly. However, we do know that it has been increasing over the last 10 years, so there is some nice operational efficiency. 6% in 2023. I would like to see this go up towards the double digits from 2024 and 2025 beyond. Free cash flow margin, we want to see a minimum of 5%. We do see it pretty inconsistent, but I am hoping 2024 it does continue to show us that they will be hitting strong free cash flow year on year. Finally, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Remember, this essentially correlates to that balance sheet strength. What this shows us in 2023, it would take them 0.61 years to pay off all of their debt net of cash on hand. The maximum we want to see here is 3, so for it to be down to 0.51 expected in 2024 and below 1 in 2023 is very, very strong. So, no real causes for concerns. Now let's get into the main part, the valuation of Amazon. Now, typically, to get to the intrinsic value for the companies we do deep dives on, we use Graham's valuation, the multiples valuation, dividend discount, and the DCF. For today's model, only appropriate we believe is the DCF model for Amazon. So we have the free cash flow year on year. We can see it went from negative 11.7 billion in 2022 to a massive 37 billion in 2023. Now, the average growth rate over the last 10 years has been negative 3%. Forward looking, now remember they expect next year to be 100%. So what we're trying to calculate here is the expectation over the next 10 years. So we've gone for 3 different rates. We've gone for a low, medium, and high. And in today's episode, we started off with a low. And this is essentially what we actually believe it probably will be in terms of our valuation. So we have the growth rate, the discount rate. Based on this, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value. Divide by shares outstanding, we get our intrinsic value of $185, giving us an undervaluation signal. We then move on to a medium growth rate of 24%, and we do input that into this model, and we can see the intrinsic value goes around $237. If that is what you believe, then there is around 36% upside from the current trading price, and we have gone for a final high of 28%, and this comes to that intrinsic value of $301, signaling 72% upside. Now, these will be derived based on what you think over the next 10 years. Just next year, Amazon do see around 100% growth to the free cash flow. So whilst we're not going to put 100% into the model, what this essentially means 20% year on year for the next 10 years and beyond. So again, this does come down to your essential investment thesis. And as well, you can grab a copy of this model if you want to get to the intrinsic value of companies in your own portfolio, on your watch list, or even if you want to run through Amazon based on your own numbers. So forward looking, we're going to stake that 20% growth rate, which we see as a low rate, into the intrinsic value calculator. So for today's episode of Amazon, we are getting to that model price of 185. Now, current price at 175, we always start off with a margin of safety of 10%, and we use this if we believe the company meets the 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that for Amazon, then it is a buy at to 167. If you believe a 15% margin of safety at 158 and around 20% around 148. So right now we see it around a 5% margin of safety. As always though, do let us know your thoughts in the comments below, whether or not Amazon is one you continue to add. Maybe you're waiting for a certain price, or you currently believe it is overvalued, or you just don't want it. Personally, this is one that I do hold, however, indirectly through ETFs. Right now, a 5% margin of safety is a little bit too small for me to be interested. If we do see around 15%, then this one that I will have on the watch list at around the $160 mark. So in terms of Wall Street price forecast, we can see, in fact, over the next 12 months, they are very bullish on Amazon. They have upside of 19% and a price target of $208. So they see this as a very strong buy now. As always, keen to hear your thoughts. Let me know in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, we'll see you on the next one.